So this segment, we're going to take a look at business combination. This time, we're going to look at a question called Red Corporation and Saks Inc. Now, before we do this question, and this question is all about, again, consolidation, preparing consolidation on the day of acquisition. But before we get started with the question, I thought we would take a look at a couple of technical materials. So first of all, the only method of choice for consolidation is the acquisition method. And the acquisition method says we need to reflect the cost of acquiring a controlling position of another company, and that cost should include any cash paid and or any fair value of the net asset transfers, or perhaps the acquisition could be not a cash, but it could be that I give land and buildings, so we need to look at the fair value of the assets transferred. So I would transfer land and building or patent, for example, to get a controlling interest of another company. Or we could also include in the acquisition cost the present value of any promises to pay in cash in the future. So any future cash payments, we need to also incorporate that and present value. The fair value of any share issued should be based on market price of the shares. And again, that market price would be the average of a reasonable time period before and after the date of combination. So that's the thing. You can't just look at the day of. You have to look at the average share prices before and after the date of the combination. Now, there's also what we call contingent consideration, which we're not going to cover today, but essentially we need to also factor in the cost of acquiring the investment or the controlling interest. Perhaps may include contingent consideration. And an example of that would be, let's say, the acquirer would pay additional purchase price if the acquiree's income reaches a certain threshold over the next 5 years. That would be what we call contingent consideration. Okay? Now, the couple things to note: acquisition costs do not include consulting fees. In other words, if I paid a broker to perhaps brokerage the sale of my controlling interest of another company, or finder's fees or consulting fees, they do not get included in the acquisition cost. So any accountant's fees or lawyer's fees, because they do not increase the fair value of the acquired company. These costs should be expensed in the period of acquisition. So we need to debit some sort of expense on the acquirers and credit cash. Now, if we decided to issue shares as part of the acquisition, the cost of registering and issuing these shares are considered capital transactions, and therefore they would not be recorded in the acquisition cost either, and they would record as part of shareholders' equity. So it's no different than you going out and issuing shares. You would include any of those share costs as part of capital transaction. Now, once we determine what the price of the acquisition cost, we need to allocate those acquisition cost to the acquirer's percentage interest in the fair value of identifiable assets and liabilities of the acquiree. So that's what we need to do. We need to allocate it to determine essentially the amount of goodwill. Now, identifiable assets should include those values not presently recorded by the acquiree. So oftentimes the acquiree would have internally developed R&D. They may have a favorable lease term or a favorable location in the mall, for example. So such identifiable assets, as long as we can identify those assets. Now, identifiable assets arising from contractual or legal rights or being capable of being separately sold. So that's how we determine these identifiable intangible assets. So oftentimes the acquiree would not record those assets on their local books. But when you're buying a business, a controlling interest, you would need to outsource those. We need to be able to determine what those identifiable assets, intangible assets, and the rules that we use is as long as those assets can be contractually or other legal rights, or they are assets that can be capably separately unsold. Okay? Now, failure to allocate the identifiable assets would inflate goodwill. So, irrespective of whether we don't identify or not, it would just mean that our goodwill will be higher. And of course, goodwill, high goodwill, we only really test for impairment of goodwill. We don't amortize goodwill anymore. So perhaps we may inflate income on a go-forward basis if we push all of that identifiable assets to goodwill. Couple of things to note. Deferred income tax assets and liabilities recorded on the subsidiaries' balance sheets are not revalued and carried forward, but instead are being replaced by new calculation of deferred taxes. So what does that mean? So it means that if the acquiree has deferred taxes on the books, what we need to do is we need to look at the net identifiable assets that we acquired either through share or net asset purchase, and we have to calculate the new deferred taxes based on the acquirer's perspective of whether these future income taxes can be recorded or not. Now, any excess of cost over the foregoing represents goodwill, and that's essentially goodwill is the premium paid to achieve control. Okay, so let's take a look at the question. The question is, on July 31st, year 3, two companies that are party to a business combination are as follows. So you've got Red Corporation is the acquirer and Saks is the acquiree. And they purchase, so in addition to the capital asset identifiable above, Red attributed a value of $100,000 to Saks assembled worker. So Red buys S. Okay. Now, these assembled workers, they have knowledge and skill to operate Saks manufacturing facilities and are critical to the success of the operation. So essentially, Saks' balance sheet did not reflect a value called the assembled workforce. Although the 8 manufacturing employees are not under any employment contracts, management of Red was willing to pay $100,000. So they were willing to pay $100,000 more on the purchase price on the belief that most or all of these employees would continue to work for the company. Effectively, on August 1st, year 3, the shareholders of Saks accept an offer to purchase all of their common shares. So this is August 1st. Year 3 is when it happens. This is when the control date happens. And so this is a 100% common share purchased. Red's cost of investigating and drawing up the share agreement amounted to 18. So this is the acquisition cost. Is 18,000. And we just read, right? We just read a couple of the couple of technical item that says these acquisition costs should be expensed. So we're going to expense that acquisition cost. Now remember, there's also the purchase price is, in this case, is the purchase price is $960,000 cash. That's the purchase price. Now, in that includes the assembled workers. So let's actually take a look at the assembled worker for a minute. So assembled worker is specifically covered in IFRS 3. And it's paragraph B37. And it says assembled workers or workforce is not considered an identifiable asset. So it specifically says it should not be recorded as one of your intangible assets. Any fair value differences arising from the assembled workforce is included as part of goodwill, not as a separate identifiable asset. So if you remember the criteria for recording a separable identifiable asset, apart from goodwill, requires that the asset can either meet the contractual legal criterion or it can be separated. Remember, those were the criteria. Or it can be separately and it can be sold or contracted separately. So that is the assets from a contractual or legal rights, regardless of whether those rights are transferable or separable from the acquired enterprise or from other rights and obligations. So that would be like the lease, the favorable lease agreement that we saw in the other question that we did, the D&H company, or the assets capable of being separated or divided from the acquired enterprise and sold, transferred, licensed, rented, or exchanged, regardless of whether there is an intent to do so. So that's the criteria for separating out the acquisition differential into its intangible assets. But assembled worker is one of those ones that you would think, because they were willing to pay $100,000 more on the purchase price because they have these incredible workforce that are talented and know the way the manufacturing plant of S company should be run. The fact of the matter is, it specifically says that these are not included in as a separate intangible asset. Okay, so having said that, let's take a look at how we solve this problem. So part A asked us to, it says assume that, so we're doing part A. It says assume that Red made a $960,000 cash to the shareholders of Saks for 100% of shares. So this is a 100% share purchase. They want us to prepare a journal entry to record Red, to record the share of acquisition, and they want us to prepare the consolidated balance sheet of Red, so R. Okay? So the first one is we're going to record the investment, so debit investment in SAC. And this time it's $960,000. Remember, we need to record the professional fees. And we're going to expense this, right? Of $18,000. That's this $18,000 acquisition cost. And we're going to credit cash. Now, unlike the D&H question we just did in the previous video, this is a share acquisition, which means that we only have an investment on the books of Red. So this is in the books of Red. And of course, at the end of each reporting period, we need to provide a consolidated balance sheet of Red company, right? So the first step we need to do is we need to analyze the purchase price. and acquisition differential. So the purchase price at 100% is $960. We're going to subtract fair value of assets. This is of S company. And the fair value of S company's asset, if you add the current asset, plan asset, and patent, $468,000 plus $972 plus $72,000, we get $1,512,000. Okay, and then we're going to subtract, deduct fair value of liabilities of S company, and that would be $252 plus $384. And that gives us $876. Goodwill is $84. Remember, assembled workforce should be zero value, right, as per IFRS 3. And I believe the paragraph, for those of you that want to double check that, the paragraph is B37. Okay, it's good to kind of get used to the handbook as well, so I might encourage you to flip the handbook and see if you could take a look at that section. All right, so now we're about to do the consolidated balance sheet. Okay. So we've got consolidated balance sheet, and this would be Red Corporation. And this is August 1st, year 3. Again, we're going to start with current asset. So we're going to take the book value of R, okay, plus the fair value of S, and remember, we paid cash, didn't we? Right? We took out $978,000 worth of cash to pay for this. So we're going to subtract $7,978. So this is the cash paid. And that will give us $1 million. Okay? Plant and equipment. So let me just short form that, P&E. It's $1,080,000 plus $972,000. Same idea. Book value of R, fair value of S. That gives me $2,062. Patent. We don't have any value, but we do have a value on Red's Corporation, right? And of course, we've got goodwill. And goodwill we just calculated, didn't we? Of $84,000. Current liabilities. We take Red's current liability, and we're going to add the fair value. In this case, fair value and book value are the same. Long-term debt, 480 plus 384. Common shares. And this would only be reds, right? And then retained earnings. Retained earnings would only be reds, right? And that would be 120,000. But remember, we need to subtract 18,000 for that professional development. Professional expenses, not development expenses. And that would be 102. Altogether, that's 3,298,000. Now, for part B, it says, assume that Red issued 120,000 common shares with market value of 8 to the shareholders of Zacks for 100% of the share. So this time, it's a share purchase. So the second part is, so part B says R buys 100% of S. But this time, it's not a cash purchase. It's going to be a share exchange. And how much is so Red issued 120,000 common shares with market value of $8. Now, it says that legal fees associated with issuing the shares were, so there were legal fees for issuing shares is $6,000. And it says, and were paid in cash. Red is identified as the acquirer. So it's asking us to redo the exercise, except this time we've included the 6,000 plus. Remember, there was a professional fees, wasn't there? Of 18,000. Right? There were professional fees of 18,000. But we know through the technical material that any professional fees paid to accountants and lawyers should not be recorded as part of the acquisition cost. It should be expense. And if there were any share issuance, acquisition related costs associated with issuing shares, we would also record that as a capital transaction. Now, we also know that if we're issuing shares, so if Red's issuing shares, it would need to look at the market value of these shares within a reasonable time before and after the date of combination. Okay? So let's take a look at this question. So this question is, now we're going to look at part A. So number one is we need to record the investment. So first we're going to we're going to debit investment in Saks. And the investment in Saks is still $960. Now how did I get $960? It's going to be 120 times $8. Now, remember, we're going to debit professional expenses for that 18,000. Okay, we're going to credit cash for that professional fees. right? And we're going to credit common shares for the 120 times the 8, subtract the 6,000. That means that I need to add the 6,000 here. So this is actually 24,000. Okay? So how did I get these numbers? Remember, these are the professional fees that we had to pay. So we know that we paid cash for them. We also had issuing shares, right? We issued the shares. That also needs to be reflected as a capital transaction as well. Okay? So that's an important aspect of the question is any incidental fees associated with acquiring a company should never be recorded as part of the acquisition cost. It should be recorded as either an expense if it's a professional fees, or if it's related to share issuance, it should be deducted against shares, the common shares. It's a share capital transaction. Now, this is part A, and part B is to calculate goodwill. And this is the same as part A. So in other words, we calculated goodwill, and the goodwill that we calculated should be the same, right? So it should be the same, and assembled workers continue to be of no value as well. Okay? And now we're going to do the consolidated balance sheet of red. So Red Corporation, consolidated balance sheet as at August 1st, year 3. Current asset, I'm going to short form that. So it's again, the book value of S plus the fair value of S minus 18 minus 6. These were the acquisition costs, right? And this is book value of R plus fair value of S. Okay? That gives me 2,044,000. Plant and equipment, same idea, book value of R plus fair value of S. Patent, still the 72. And goodwill was the calculated amount. Current liabilities, it's again book value of R plus fair value of S. Long-term debt, so you notice that these are very similar to what we just did, right? The part A to this question. Common shares. Now this time it would be the 720, which is R. So this is only R, reds only, right? But remember, we issued shares, didn't we? And there was a common share issuance cost, so that's why that's why this is going to be different. So this is different from part A. And retained earnings, again, reds only. And the retained earning should be the same, right? 120 minus the 18. So this would be 102. So what is different obviously, what's different is this is different because we paid the extra 18. So that number is different because we paid the extra 18. And also, we didn't pay cash. We issued shares instead in Part B. This is the same. So I'm going to put down the word in red. I'm going to put down the same. And then I say same as A. And that's the same as A. And that's the same as A. And this is the same as A. Okay, the long-term debt is the same as A, but this is different. Obviously, this is a much different number. And also, this is the same as A. Okay? Now, the last part to the question says, would the assumption in A result in higher earnings to RED than those in assumption of B? So the price paid for the investment is the same in both A and B. So one could argue that the future earnings from SACS should be the same. However, the financing of these two purchases are different. In Part A, we use cash. In Part B, we use shares. And cash is, in fact, intact. So if you think about it, you've got less cash means you have less ability to buy stuff, to expand, perhaps. And the fact that the matter is, in Part A, there's less cash. In Part B means that perhaps the earnings in Part B, issuing shares, may be slightly higher because you have extra cash to do stuff. And that's essentially what the difference here. Okay? Thank you.